What you see today, I'll put up on my website and it'll get a broader reach that way. But what I'm going to talk about today is some general trends that I see in the Australian junior sector. How are they tracking? What's their outlook? I'm going to cover about 3 or 4 items fairly quickly. I'm going to talk a little bit about how much money is spent on exploration in Australia, what's the junior share of that, how many discoveries are made and who made them, what's the role of the junior sector in that regard, and from that you can make an assessment of what the financial performance is, what I call the bang for buck. In other words, you spend some money and what do you get back in return. And then I'll step into the financial health of the junior sector, how we're going in terms of raising money and surviving any sort of headwinds that might be coming up. So first of all, how much money is spent on exploration in Australia? As a rough rule, according to the ABS, we're tracking towards $4 billion Aussie for this calendar year, which is actually pretty close to an all-time high. And you can see that from this chart here, which is made up of majors and juniors, just broken down by the commodities that are there. You can see from that that gold is quite a key play. And also you can see from this chart that exploration is not for the dull and boring. It's certainly an exciting one on the way up and a scary one on the way down. But it's certainly influenced by the business cycle, and you need to recognise that as a company and as a junior. You can see that the good news is that between 2016 and now, the industry has grown in real terms by a factor of over 2.4. So it's good on the way up. In terms of the role and importance of the junior sector, they account for about 30 to 50% of the exploration spend, depending on where you are in the business cycle. And you can see that from this chart here. These are some numbers that I compiled based on ABS and also from S&P, showing the breakdown between the majors, the juniors and the intermediate companies. And you can't read the fine print there, but a major company is something that's got a sales revenue of US $500 million or more. An intermediate is something between 50 and 500, and a junior company is defined by them as something with less than $50 million a cap, and actually, revenues. And many of them have no revenue at all, and others have to rely on the goodwill and faith and persistence of their shareholders to survive. You can see that the junior companies make up an important part of the exploration scene here in Australia. If you normalise that to 100%, you can get a feel for how the market share for juniors, intermediates and majors has changed over time. The junior sector was its biggest and most flushest time back in about 2011, at the top of the last business cycle. Contracted a little bit as the majors stepped back into that space, but on average over the last decade, the majors and intermediate sized companies made up 57% of the dollars spent, and the juniors accounted for 42%. So they play a very important role in terms of the exploration activity in the country. And in terms of the junior sector itself, you can get a sense of what commodities are of interest to them. You can see that there's a wide range of commodities there. They're not just focused on one or two. So these commodities go in and out of fashion over time, which is an important point to note, and it's where we are at the moment. So if you normalise that to 100%, you can get a sense of how the flavours of the month or the flavours of the year change over time. 2 things sort of jump out at me, or 3 things jump out at me at the same time. There's been quite a dramatic, sustained growth in the other spend, and this is really driven by PGEs out of the Julimar project, by Chalice in Western Australia, lithium by just about everybody in the country, and rare earth elements as well, taking up a large part of the spend. But the main game in town, you may not recognise it, but it still is gold. It still makes up nearly half of the total spend in the country for the junior sector. And you can see that the base metals, copper, nickel and zinc, they go in and out of fashion as commodity prices go up and down. And for a little while there in the early 2000s, the junior sector had a love affair for coal and iron ore, but that's disappeared over time. Actually, there is one more point to make on this chart, and that is you get the sense when you talk to, you go around the booths here in at the conference, every second booth has got the word critical minerals in there, and you get the feel that lithium is the one and only commodity of interest. But the reality is that we're currently juniors are only spending about 10% of their overall exploration budget on looking for that particular mineral. So it gets a lot of airplay, but in terms of spend in the ground, gold is still the main game. Okay, how many discoveries are made and who made them? If you look at the number of discoveries by company type, there's around about 20 discoveries made overall in Australia. What I define as significant is something that's more than 100,000 ounces of gold or 100,000 tonnes of copper equivalent. We make about 20 of those in Australia each year. It takes a little while for some of these deposits to actually get into the public domain. It takes time to drill them out and report the resources. They do grow over time as well, but I make an estimate of those unreported discoveries, and that's the grey bars at the end. If you don't, you get a very misleading result of what the health and the performance of the industry is. But we're still making quite a significant number of discoveries, and over the last 30 odd years or so, I've got records of information on nearly 700 of them. But you can see from the dark blue there that the majors and intermediate companies, their role in making the greenfields discoveries has diminished progressively over time. And if you normalise that to 100%, you can see that trend very clearly. That most of the discoveries that are being made in Australia over the last decade are associated with the junior sector. And I estimate that about 75%, 3/4 of all the discoveries made in the last decade are associated with the junior sector, and the majors only make up about 20%. So they're doing much of the heavy lifting for the industry. So in terms of the financial health, I'd like to talk about how the junior sector finances itself. Because it doesn't have a cash flow, in many cases it doesn't have a mine, it relies on the faith and persistence of its shareholders. And the ability to raise money varies over the business cycle. So this is a chart that I compile from looking at all of the quarterly reports that junior companies put out. It's not complete, it covers quite a good sample cross-section of about 300 or so junior explorers, and looking at their financial position in a very simple sense. How much money do they have in the bank, and how much are they spending to do their work? And the spending on the work is made up of two components: the admin costs, running the office, keeping the lights on, and actually doing work, money in the ground. Now you can see very quickly that when capital rises, stops coming in, they start to burn down their cash reserves, which is what happened in 2012, and the first response is to cut back on the infield work. Your admin costs are fixed, as I mentioned before, and as a consequence, all of the pain and anguish that occurs during a downturn is usually in the field work side of things. So if you're a service contractor, being a drilling company or an analytical services or a consultant in a general sense, they're pretty lean times. But you can see in the last year or so, based on the survey that I've done, cash reserves for the junior sector actually built up quite strongly. So the companies have, over the last 12 months or so, last 2 years actually, have done quite a lot of work building their balance sheets for the future. Whereas overall exploration spend for the year for the junior sector per company has only gone up by about 8%. So they're building up a sort of a hollow log of money there to help them through the tough times that may be coming into the future. There's a lot of uncertainty out there, and I can see why they do this. The challenge is that if the ability to raise money is diminished, will we go through another tough time like we did 10 years ago? And the reality is the business cycle is not dead, so you just need to live with that. But an interesting and important point to look at is the cash burn rate for the industry. On an individual company basis, if you look at how much money in the bank and how much they actually spend on an annualised basis, the average junior company has around about 1 to 1.5 years of cash reserves in place. Of course, you get a quarter of the companies have got probably 3 to 6 months worth of money in the bank, but there are also a similar number of companies that have got 3 or 4 years worth of money in the bank. But on average, the industry's got over 1 year plus of money in cash reserves to survive till the next funding. And where we are in September 22 is about 1.24 years. So it's actually better. It's better than the long-term average in terms of what the funding levels are. So I can see that the junior sector is concerned about their inability to raise money at the moment because of the uncertainty and higher interest rates. So they are trying to build up a reserve there to get them through the tough times. Yeah, another sort of leading indicator is the number of IPOs that are going out there. You can see that 2006 was the boom year where we had nearly 150 IPOs. But in the last 3 or 4 years, there was certainly a run up there, and 2011 was probably 2021 was a banner year with 105 listings. But in the current year, we've only had 57. The pool is starting to dry up. And that's sort of a reflection of inability of raising money, but it also is a reflection of the lack of quality projects to do an IPO on. So companies who are trying to raise money need to have quality projects. There is money out there for good stories. But it is a sort of a leading indicator that there may be some headwinds into the future, the fact that the IPO story is starting to quieten down. So going into sort of summary and conclusions, from the statistics that I put together, over the last 10 years, the last decade, the junior companies accounted for 42% of the exploration spend, and the majors were 57%. If you looked at in terms of the number of discoveries, they accounted for 75% of all of the discoveries that were made in Australia over the last decade, the juniors. But you should look at it in terms of the breakdown of the deposit sizes. A lot of those discoveries that were made by the juniors were in the sort of the moderate size category, fairly modest in size. So whereas the majors were more focused on the bigger deposits. So just looking at the 75-20 split overall can give you a little bit of a misleading story because the majors tend to look for the big deposits and they're harder to find. In terms of the value that was created, using sort of an NPV approach on the discoveries that were made, the majors accounted for 32% of the value and 64%, and the juniors accounted for 64% of the value. But if you actually look at the numbers in a more general sense, if you look at the fact that we spent $23 billion or so on exploration in US dollar terms, and we created $28 billion or $30 billion worth of value out of that in US dollar terms, the bang for buck has actually been quite positive for the industry overall. In Australia over the last decade, for every dollar you put in, you got $1.38 back. So it was a good investment, but when you look at it in terms of the juniors versus majors, you actually get a much more interesting story, and that is the juniors actually did pretty well on average. Every dollar you put in, you got $2.10 back, whereas the majors were only getting 60 cents or so back. So that's a sort of a telling message there about the focus or lack of focus by the majors on doing greenfields exploration. So that's what I call the bang for buck. And it's important to do that, to be more than one, otherwise the industry is not sustainable. So in conclusion, exploration expenditures are currently running around about 4 billion Aussie in 2022, which is close to the previous record 10 years ago. The junior sector accounts for about $1.7 billion of that, and over the last decade, the junior companies accounted for 42% of total spend, and the majors 57%. Contrary to what you see and hear in the press, what you see out in the booths this week, the juniors are not all of the dollars are being spent on lithium and rare earths and critical minerals. Gold is still the main play in town, but one of the reasons why they're doing this is really it's a good story to raise money. So it's much easier to raise money with a critical mineral story than it is with a boring old story about looking for another copper deposit or another gold deposit. But even though that's where the money could be. I tell junior companies and exploration companies, don't focus on the fashionable things. Focus on where you've got quality projects and you have the skill and expertise to be better than average. In terms of the number of discoveries and who made them, 169 or so significant discoveries were made in Australia when you count the unreported ones. 75% or 3/4 of those were made by juniors, and the majors only accounted for 20. But the majors were focused more on the bigger end of bigger scale deposits which are harder to find. And the juniors were finding a lot of small ones which not necessarily have a great value. But when you put the story together, You know, per every dollar that was spent in Australia, you got $1.38 back, which is a great story for the industry in general, but it's a cautionary tale for the majors and a celebratory story for the juniors. They've done well, and they should be congratulated for that. And in terms of the financial health of the junior sector, they're always scratching for money, always looking for funds to fund their next program. To do that, you need to raise money from the market. I think if you've got a good story, you still can raise money. The average junior, which is a very misleading term, spends about $5.6 million a year on exploration. That has $7 million in the bank, and if they manage that properly, they can go for a year or two without having to raise additional funds. So they've got enough sort of money in the till to survive any short-term drought of cash reserves. I mean, times can be tough, but I have a very positive outlook for the industry at all. So I'd say the industry is quite positive for the junior sector. And if you want a copy of this presentation, which I'll put up on the website on the weekend, you can, someone else is driving this. You can go to my website and download a copy of this. You'll find this and 50 other presentations that I've done in recent years there as well. So thank you for your time and thank you for your patience.